the paradigm has shifted dramatically. And I think that people that are looking at the past 30 years for guidance on how to invest for the next 3 months, 6 months, 3 years, 10 years are looking in the wrong place.
And today we're joined by James Davolos. He's the Vice President and Portfolio Manager at Horizon Kinetics. All the ideas you're going to talk about with us today, James, are thematic of your inflation beneficiary fund, which means that you are a shareholder directly or indirectly of all the ideas we're going to discuss. I want to get your global macro outlook first. And I think it's quite interesting because you really focus on us moving from an era of abundance to an era of scarcity. Describe that for us.
Yeah, absolutely. And I think that's a great place to start because we launched the Inflation Beneficiaries Fund in early 2021 when CPI was still below 2. People thought we were crazy to be talking about higher inflation, but we'd actually been worried about it going back to call it 2015, 2016, where our chief investment officer, Murray Stahl, basically came up with a thesis where he said, look, valuations are high. The only reason that you can really look at is financial asset inflation. And money supply was growing around 6% a year. Interest rates were extremely low. It was a slow burn, but eventually there was going to be inflation. But the real differentiated view there is that we looked at things from a supply side as opposed to purely from a demand side. And we have a thesis that the prior 30 years were actually artificially low inflation, i.e. disinflation, because of an era of abundance. And that era of abundance really coincided with cheap labor and cheap materials, primarily from the East being shipped to the West. And so that really created disinflation in the West. But a confluence of factors, one of which being the pandemic and reshoring with supply chains, but also just rising GDP per capita, which is parlance for rising standard of living in these nations where we've had an abundance of commodities and labor for the past 30 years, is actually shifting to where now they're actually competing for the same commodities and labor as us. And so the paradigm has shifted dramatically. And I think that people that are looking at the past 30 years for guidance on how to invest for the next 3 months, 6 months, 3 years, 10 years are looking in the wrong place.
And you really look at higher structural inflation and walk us through what that means exactly.
Yeah, again, that's a really important point as well, where a lot of people misrepresent inflation because there's really two types of inflation. There's cyclical inflation and there's structural inflation. And you could argue that a lot of inflation in the past couple of years, or certainly the past 18 months, has been cyclical, related to a lot of money entering the system. The money supply in the US grew over 40% over an 18-month period, some of which was money literally being handed into the bank accounts of consumers. And so you saw things like used automobiles, microprocessors, home goods, things that people were doing renovations, things like that, where there's a cyclical mismatch between supply and demand. But lo and behold, we're going to make more cars. There's going to be more semiconductors. There's going to be plenty more refrigerators and countertops and washing machines. That's cyclical, and that can be impacted by demand, but also the supply is going to respond very aggressively. We're already seeing that. The other type of inflation, which is a lot more pernicious and a lot more important going forward, is structural. And what I mean by structural are things that are far less inelastic in their demand profile. So think about energy, food, raw materials that are requisite to our daily lives. And demand there is far less elastic, meaning that people are going to heat their homes, they're going to drive their cars, they're going to eat food. But the supply side takes a far longer time to really catch up to demand, where, okay, there's a couple short cycle energy wells in the shale patch, but most of that is 3-5 years. Copper ranges from 7 to 10 years. Food, you have a whole planting season, and it really depends if you have the infrastructure in place. And so that is the structural inflation that we think the paradigm has really shifted in, and where the market is really missing the forest for the trees.
Hi, I'm Raoul Pal, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
And James, before we get to your 3 ideas, you have this nugget that really fascinates me. So if you could give investors just one piece of advice, what would it be?
I'd say one piece of advice that I would give to investors is to always seek out unique data or information. And what I mean by that is it's easy to just look at what the headlines on Bloomberg or the Wall Street Journal are, or see what Morgan Stanley or Bank of America is saying about a company, but everybody sees that, everybody knows that. There's so much value to be unlocked looking at industry specific information. So trade magazines or local newspapers, things like that, where you're just going to be getting unique information that can really formulate a unique opinion that's not just consensus. I'd say that's been invaluable in my career, and really highly recommend it.
So I want to jump into your first idea because it really plays off exactly what you're talking about here. And that first idea is PrairieSky. Now, this is a Canadian listed company, one of the largest Canadian oil and gas royalty companies, emphasis on royalties. And if you can really walk us through the upstream, midstream, and low stream that you look so closely at, because that's really important here in terms of getting all those different royalties.
Yeah. And so just to be clear, there in the energy sector, most people are familiar with the upstream, which is companies that spend a tremendous amount of money to explore for and extract oil and gas. So you spend a lot of money exploring, and then you spend a lot of money drilling, and then obviously a lot of money getting that oil to market. So that brings up the second part of the supply chain, which is the midstream. Midstream are pipelines and gathering facilities and storage facilities that basically bring the gas to market. And then finally, downstream is the gas station or the retail distribution where it actually ends up with the end consumer or business. The problem with all 3 of these businesses is that they're incredibly capital intensive. So you spend a tremendous amount of money up front for what is typically a low return on assets. Meaning you spend a lot of money to make a little money. So the companies tend to use a lot of debt in order to enhance the returns on equity, and that's fine. But if you spend money at the wrong part of the cycle, or you're wrong, or there's a very pernicious down cycle, you tend to impair a lot of capital in these businesses. The reason why royalties are such a eloquent business model and not really properly appreciated in the market is that they remove a lot of that capital intensity, because a royalty in its purest form is purely a revenue interest in the production of another oil company. So again, go back to those upstream companies. In Canada, let's say Canadian Natural Resources or Suncor. In the US, you could compare those to Exxon and Chevron and Conoco. They might be spending hundreds of millions, if not billions of dollars extracting oil and gas. But you as a royalty holder have a cost-free revenue participation in that production. So what that means is the more they produce, the more revenue you make. The higher the price, the more revenue you make. So in a world of rising production and prices, all of this revenue flows through to you, generally cost-free. So because of that, royalties such as PrairieSky can operate around 90% cash margins, and they need to reinvest very little capital. This is going to be absolutely critical as the commodity cycle matures, because at the beginning of the cycle, everybody's making huge amounts of money because costs haven't really filtered through the system. So again, going back to the Chevron or Canadian Natural example, they have a lot of upfront costs, whether it's labor, whether it's equipment, things like piping and frac crews and frac spreads and trucks and you name it. It's a very capital intensive industry. That cost inflation is just beginning to hit right now. And so that's actually going to hurt their margins. But then the longer effect on margins is going to be reinvestment. So if you were reinvesting capital at $40 oil, you're probably pretty happy right now. If you're trying to reinvest in a world of $90, $100, $120 crude, you're going to have much higher prices to pay. So that's why we think that the royalty business model is so advantaged and a really eloquent way to play what we think is going to be a secular rise in energy prices worldwide.
So you lay out a very eloquent thesis, and you end right there on that secular rise, which leads me to my question: why now? Why PrairieSky now? I mean, if we go back and we look to 2014, trading at about $42 Canadian dollars, now we're at about $17. So why now?
So I think there's obviously the macro where we're very bullish on energy prices, both oil and gas, but just focusing on oil right now. Right now, you have the market, which has the SPR release, the Strategic Petroleum Reserve in the US, which is adding artificial temporary supply. But if you look at rig counts in the US and Canada, they're actually lower today than they were back, a few months ago. So we're setting up for a huge supply disappointment that's coincided with what appears to be a China reopening from its zero COVID policy in November. The reason I'm optimistic about that is that we're seeing junket operators, which basically are government sanctioned tours to Macau and Singapore, starting to do advanced bookings for October and November after being shut down for a long time. So let's call it 1 million barrels a day of temporary additions to supply from the SPR and about 2 million of lost demand from China. If you have those 3 million barrels coming back and you have risks related to OPEC production and Russian barrels on the market, we think that there's a very high asymmetry towards higher energy prices. But specifically as it pertains to Canada, I think Canada is setting up for a rise in production for a variety of reasons. One of which is that Canada has shifted from being very heavy in bitumen, which is heavy, viscous, high sulfur oil sand, towards more intermediate grade crudes, which are comparable to North Sea or conventional oil. As you're seeing more and more geopolitical risk in barrels around the world, I think that there's going to be a premium on getting Canadian oil. Plus, this Canadian mid-grade oil is absolutely vital to the U.S. refinery complex. As it pertains to gas, obviously the world is in a borderline gas crisis, notwithstanding what's happening with Nord Stream 1. However, if the world really is going to have a large, robust market of liquefied natural gas exports, Canada is going to be crucial. You're starting to see the government open up to LNG export in the West Coast in Kitimat and then also on the East Coast. Canadian gas trades at a huge discount to global benchmarks because it's locked in Canada. Similar dynamics for Canadian crude. So anything that kind of eases that locked crude because of infrastructure plus higher production can really lead to an outbreak in Canadian differentials and production levels. So we think that all of these catalysts could lead to lead to much higher than market expectations over the next, call it 3 to 6 months, but then obviously more and more optionality as you look further out.
Well, and I wanted to ask you about that time frame. So you're saying 3 to 6 months, and I hear you on the Canadian rise in production that you foresee, but a lot of this has to pivot on China reopening. And so I'm curious how that's going to affect your time frame, because the truth is, none of us know. Though you're talking about, the bookings that people are making now. So how do you factor that in?
Yeah, that's a great point. I mean, obviously you have the big Communist Party event coming up in the next couple of months, but China is the huge known unknown. But again, even excluding China for a moment, you have the end of the SPR release, which is supposed to be ending in the next couple of months. I mean, they've extended it a little bit. But I think that that's going to coincide with a big disappointment in conventional supply. You're seeing OPEC, which is habitually underproducing their quota, which the latest report was 3 million barrels a day. Russia's actually pushing for a decline of 1 million barrels in the OPEC plus cartel. So it seems as though a lot of things are coinciding for something to materialize in the November timeframe, which not so coincidentally aligns with U.S. midterm elections. And so I think that date, there's just a lot of things happening in terms of potential reopening, SPR release ending, OPEC seeming like they really want to defend $85, $90 a barrel, where again, it just seems that there's a lot of asymmetry to the upside rather than the downside around that date in November.
And you're talking about a lot of the variables there, but what's something that isn't one of those variables? Not China reopening necessarily, not the U.S. election, but that could cause you to fundamentally rethink this idea.
Yeah, I mean, obviously, there's always the macro component where it would take a very, very devastating recession to meaningfully impair energy demand to actually result in a decline in demand. Just to give you an idea, the non-OECD world actually grew its demand through 2008 and 2009, and the whole world actually was back at 2007 level of consumption by 2010. So that just shows you that it takes a really, really severe and deep recession to impair consumption. I'd say, as it pertains specifically to PrairieSky, the government in Canada really is a wild card. It's such a critical business to their economy, and it's critical to balancing secure, necessary energy for the whole world. But again, it's almost impossible to handicap what governments are going to do. And I think between the macro and then the specific jurisdictional risk within Canada, particularly, I think that those would be some things that might cause us to reconsider our view.
I want to jump into your second idea. That's Archer-Daniels-Midland, a name that's known to so many folks, a global agribusiness. I'm surprised to see this here because of everything that we've seen with food supply, with bad crops, with the war in Ukraine. So walk us through, and as we zoom out, we look at a company that was trading at about $97 back in April. Now it's at about $81. So why now?
Yeah, so I think this really holds for all of the companies we're discussing and a lot of these hard asset companies, but the market seems to believe that there was an anomalous spike in profitability for the agribusinesses. And it believes that because there was a spike in wheat prices, corn prices, soybean prices, and all else equal, higher raw material prices can be passed on into intermediate goods, whether it be flours or olefins, soybean meal, soybean oil. And ADM makes a crush margin or a milling margin on basically taking the raw materials into the intermediate product. So the market basically said, look, you're earning a peak profit margin, which is not sustainable. We're going back to a 2019 world. I think that's ludicrous, given the fact that we have so many different variables that I think are going to lead to higher food prices for longer. I'll start on kind of the supply side and then get into the demand. But supply side, fertilizer prices have just went parabolic in the past year. Farmers were foregoing or reducing their fertilizer load across even Western markets, but very acutely in Eastern markets where they literally just couldn't afford fertilizer. A little backstory, a lot of fertilizers use natural gas as a feedstock to refine it. But lower fertilizer intensity is all else equal going to result in lower crop yields. That coincides with what has been a pretty disastrous growing season in the US and Brazil, where you've seen very low crop yields, you've seen some droughts and things like that. So the supply side is setting up for a disappointment. However, the demand side is the real secular story, where you have rising GDP per capita in the biggest economies in terms of population in the world. So China, India, Indonesia. As people rise from varying degrees of impoverishment, they basically demand two things higher as they move up that ladder of standard of living. One is higher energy consumption. You can argue the energy consumption mix. The other is calories. So as billions, literally billions of people are going to be demanding higher calorie and a more complex caloric mix, that's going to add to secular demand. So we think that the earnings profile and the margins of these global agribusinesses are actually going to be a lot stickier, even though the market's discounting a reversion to 2019, which again, looking at the facts on the ground, a reversion to the 2019 world is looking more and more ludicrous every day.
So, I mean, just to summarize what you're saying there, I hear two things very clearly. I mean, number one, you're talking about us moving into an era of food scarcity, more people, more demand in the countries that you were discussing. But at the same time, what I hear you saying is that higher crop prices now are going to mean the finished good prices increases. And that's where a company like ADM makes its money. That's why you think that this is a solid idea.
Yeah, basically their crushing margins, I think, are going to stay elevated with crop prices.
And what would cause you to fundamentally rethink this idea? I suppose this would have to be something major in the landscape to shift.
Yeah, I mean, one of the things is obviously there's an oligopoly of sorts going on here between ADM, Bunge, Dreyfus, and then Cargill. And then there's obviously some Eastern players. There's a China state-owned operator as well as Wilmar in Singapore. But ultimately, that oligopoly really protects their margins because they're really only a few scale players. But if we saw incremental facilities, grain elevators, railroads, ports, crushing facilities that could compete for those incremental crops, I think that would lead to lower profit margins. And we're not really seeing that yet. We're seeing a little bit of that, but I'd say that is the only thing to look at over the next couple of years. Longer term, I love to bet on human ingenuity and civilization, and I hope for society's sake that we actually do see higher crop yields and higher crop production from the same acreage. Trends do not point to that, but I do hope that happens. Let's hope that things like that do happen. But again, more crops in the market, all else equal, will result in lower prices and then lower crush margins. But again, I think that's probably a much longer term thing to look at. The more important thing to look at shorter term would again be more capacity coming on to compete for that incremental feedstock.
And so your time frame for this idea?
Again, I think a lot of this aligns with the end of this year. So let's call it 3 to 6 months where I think the market's going to realize that ultimately a lot of these pricing pressures are structural, not cyclical. Certainly, if you start seeing governments having to, I hate the word pivot, but deviate, let's call it, from current policies because something in the economy breaks, whether the dollar wreaks havoc in these emerging markets or what's happening right now in the UK with the pound, the Japanese central bank having to defend the yen. Anything around that end, I think, would result in higher inflationary pressures. And right now, one of the bigger outlets that's been surprising, I think, to economists has been how much of that ends up in food. Whereas from where I look at it, I think that's one of the most logical places for excess inflation to be ending up.
And I want to jump into your third idea. That's Brookfield Asset Management, dual listed in Canada and the United States. But let's focus on the price in Canadian dollars. It's had a peak of about $76 in November of 2021, currently trading around $57. Tell us about this company. Why does it interest you so much?
Yeah. So Brookfield, it's fascinating, but in its simplest form, it's a leading asset manager of real assets. So their verticals are real estate, renewables, infrastructure. They have a smaller traditional leverage buyout business, but then they have a credit business from a very opportunistic acquisition of Oaktree, which has specialized credit products. What really differentiates them, other than their long history, expertise, and counter-cyclical investments, is that in addition to the asset manager, which is fees, they also have a tens of billions of dollars of co-invested capital. So when you buy a share of Brookfield, you get, let's say, at least $30 to $40 per share of co-invested capital, which is compounding on your behalf, plus the fees which come from the asset management division. The asset management division is also advantaged because a large portion of their capital is perpetual because it's run through their subsidiary public companies, Brookfield Infrastructure Partners and Brookfield Renewable Partners. I really like all of these verticals because they have, quote, real yields. So a lot of these projects, whether it's infrastructure, renewables, or real estate, the rents or the tolls, whatever it may be, is often linked to a market-based measure, whether it's LIBOR or SOFR or CPI or PCE. And the world is going to be starved for rising real yields as opposed to these fixed yields or riskier types of bank debt. And so I think the overall market size is going to grow. And Brookfield has a dominant position in a lot of these markets already where I think that they're really going to thrive.
So just to be clear, Brookfield Asset Management, what's really attractive here, these are fees on third-party capital. So you're really talking about what you call permanent capital.
Yes. So In a traditional private equity fund, let's say you can tie up money for 7 years for a fund life. Brookfield has those conventional types of funds, but they also have tens of billions of dollars in publicly listed subsidiaries, which is permanent capital because those are permanent vehicles. So if you're looking at it from a fee standpoint, you know that those fees are going to be there in perpetuity, whereas a traditional private equity fund will need to re-raise that capital every 7 to 10 years.
And can we drill down a bit more on the company that you mentioned, Oaktree, because they do
Yep.
well in distress periods.
Exactly.
So you
Yep.
see a distress period in real estate here.
Yep. So Oaktree, obviously, they specialize in high yield investing, distressed workouts, and typically the last 10 years have not been good for them because global central banks have basically operated where nobody can go bankrupt. So specialty lenders such as Oaktree haven't really had a lot to do. But now that you're seeing spreads blowing out, currency volatility, you're going to see defaults, you're going to see distress. Rising interest rates are probably going to create some havoc within the real estate sector. So for the first time in probably 10 to 15 years, albeit maybe a very brief period in 2020, Oaktree is going to have their day in the sun. And I think that they're going to be able to commit a lot of capital at really high rates and that they're going to have a very high earning stream related to that over the next, call it 5, 7, 10 years.
And your time period for this?
So this one's actually really close because there's a couple moving parts that I think could catalyze a lot of value. The most pressing one is that they've already announced their intention and board approval to separate the asset management business. So basically what they're going to do is they're going to effectuate a tax-free spinoff of the asset manager where investors can value that like its peers, call it Apollo and Blackstone, where what's the multiple on fees? Then on the other side, you'll have the co-invested capital where the market can say, okay, what is the book value of these investments? What do we think it's going to grow at? I think that alone should result in a 20 to 30% re-rating of the stock at a minimum if it were to trade in line with peer companies. The other really interesting catalyst is that you have a new reinsurance business that they've been quietly but not so quietly developing. And this is important because they can buy reinsurance at book value. So effectively the net tangible asset value of the insurer. But because of the liability profile of reinsurance, which is laddered over many years, if not decades, they can then allocate that capital to Brookfield investment products, which earn fees. And I think that this could be a really interesting growth driver. Again, permanent capital with very high fees growing into a lot of their interesting liability matching. So there's a growth component there that isn't fully appreciated by the market. And then finally, again, if Oaktree really is able to deploy a lot of capital in the coming market unrest, I think the Oaktree business, which has kind of been dormant for many years, should be appreciated. So I think this is one that people should keep a very close eye on. Obviously, interest rates have hurt all rate-sensitive businesses, whether it's renewables, infrastructure, or real estate. While that might have hurt their incumbent portfolio, Brookfield is really masters of investing against the cycle. So they invested in the World Financial Center in the wake of 2001. They invested in Canary Wharf in London after 2008. Obviously, those are two of the trophy properties in the world. I mean, Hudson Yards when that was a rail yard. So you really want BAM and Bruce Flatt and their team putting your money to work during periods of unrest and uncertainty. And so, again, I think that while it might hurt the incumbent portfolio, they're going to have really interesting things to do with all of their dry powder.
I hear you, but if I had to pin you down on a month time frame, are you talking 3 to 9 months hold type of situation?
Look, I'd say there's a catalyst within 3 months with the asset manager separation, and then I keep an eye on what's happening with where they can deploy capital, how Oaktree's doing. But again, with all of these, I think that I give you a time horizon for where I think something could change the narrative as a catalyst. But I plan on holding most of these companies for years, if not decades, unless the prices really run away from fundamentals.
And I assume on Brookfield, what would cause you to rethink this idea fundamentally would be actually if the housing market strengthened.
Yeah, I think that would again help the incumbent portfolio, but it would not necessarily help their ability to reallocate new capital. But it's a really contrarian thought because if you look at market-based probabilities, would say we're going to get somewhere around 4.5–5% for interest rates next year, but then come down. If interest rates stay high for longer, meaning 10, you can go out, which is not the case today. If you can get 5, 6, 7% in 10, 20, 30-year bonds in the US, it's going to make these types of products less attractive because, again, you're targeting 5 to 7, 10% yields on risky infrastructure, renewables, and real estate. I don't think that's really possible unless we have really high inflation. But again, the more that yields go up, the more that you're competing against a risk-free instrument with the yield that you offer. So ultimately, it's going to depend on where rates are and for how long, and then obviously how that relates to inflation. Seems unlikely, but definitely something to keep an eye on.
Well, James's emphasis on companies with hard assets, but capital light is a really interesting lens to look through all of these ideas. James Davolos, Vice President and Portfolio Manager at Horizon Kinetics. Thanks so much for joining us.
Thank you. Yeah, this was great.
So let's do some takeaways from this conversation with James. And foremost, you have to keep in mind that his overarching view is that we were moving into higher inflationary times even before the pandemic. So we're definitely in those times. And what he foresees is those times becoming even more difficult. And that's why he has the ideas that he has, starting with that first idea he gave us, PrairieSky, a company that gets royalties based on the gas and oil industry there in Canada. He sees a rise in production in Canada, but of course, this is part of a much bigger play that includes China reopening, so that could affect the time horizon. He puts this at about 3 to 6 months. The second idea James talked about is US-based Archer-Daniels-Midland, a big name that many of us know. It's a global agribusiness. And I think what's so important from that discussion was he talked about food scarcity really becoming a major issue for the world, and food security, therefore, being something that's going to be key in all of our lives and geopolitical discussions. He has that at about 3 to 6 months, though. Of course, he's talking about a much bigger picture where he sees a company like Archer-Daniels-Midland benefiting from that food security, which would, of course, be difficult for many other industries and many peoples. And finally, we had that third idea, Brookfield Asset Management. This is a company that will do better because of the exposure that it has to distressed real estate. So it will do better the more problems we see in real estate. Of course, that would be upended if suddenly the real estate market did better. He sees the next 3 months as being a major catalyst in that industry.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.